Hi everybody, welcome to this edition of Kuvera Insights. Um, we have today one of the most reputed folks in the fund management industry, Mr. Jinesh Gopani. Uh,
Hi
Jinesh is the
guys.
head of equity at Axis AMC. Uh, he joined Axis in 2009 as equity fund manager and is now the head of equity since 2016. He currently manages the flagship Axis long-term equity fund amongst other funds. Prior to Axis, Jinesh was associated with Birla AMC as portfolio manager, where he was responsible for alternate assets across growth, value, and dividend baskets. He was also associated with Voyager India Capital as a senior research analyst, where he covered BFSI and infrastructure, and also held a sectoral portfolio manager role for investing. Uh, Jinesh holds a master's degree in finance from University of Mumbai, and basically he has been in the money management industry since 2007. Very warm welcome, Jinesh, and thank you so much for joining us today. Let's get into a little more uh, detail around some of the sectors, and this is sort of probably correlated with more correlated to markets directly, and something that
Sure.
is probably easier for investors to sort of understand as well.
Yeah.
Uh, and we can go sector by sector. So, what is your view on the agriculture sector and its role in public markets?
See, I think agriculture, we don't have large place to play in India, but we can play it through proxies.
Right.
So whether it is irrigation-led proxy companies, or let's say agrochemical companies or fertilizer company, and frankly, it is not a big play to play in India in that sense from the market point of view. But generally, if you see, if rural economy does well, where large part of your population resides, the momentum in the economy continues, the consumption continues, and hence even the FMCG or the consumer staple or the consumer durable companies also end up doing well. So I think tier 2, tier 3, tier 4 cities and towns and villages, I think if the momentum comes back what it was, let's say 6-7 months back, I think then things will go rolling better. So I think it's a interesting agriculture. I would not say agriculture, but rural is an interesting play. That is where the penetration opportunity for many companies is, including financial companies. And if agriculture does well, then rural gets big uplift, and we remain fairly bullish around.
So, this, in short, you expect demand creation uh, coming through if the sector does well. Of course,
Yeah,
for
I,
market.
I, I think, see, urban is doing any which ways well, but
Yes.
urban growth has not been high because it is already sort of a matured kind of a segment, I
Correct.
would say. But the way the tier 2, tier 3, tier 4 towns are uh, are growing, then I think there would be significant development which will take place. I'm just giving you an example. Let's say a case of Uttar Pradesh. It's a 20 crore population, but the per capita would be, let's say, 1/10 of the average India's per capita. You just imagine if those per capitas improve over next 3 4 5 year period, you lift the entire economy big time, because it's a large part of the consumption story. A 20 crore population, right? So almost like 20%, 15-20% of your total population. So I think the focus of this government is also to ensure that the development work in those cities continue, and hence this job creation, and hence the per capita improvement.
Right. Right. So, changing track a little bit. Uh, what about the auto sector? I mean, I tried to figure out booking times for some of the some sedans, three-door cars, and I heard that there are waiting periods of now 4 months, 5 months, extending to even 1 year for some. Uh, what do you think is going to happen? How is it going to play out?
See, frankly, if for no chip shortage last year, I think that sector would have given you good growth numbers. But for this chip shortage, and which is as per some of the companies, they say it is likely to continue for another 6 to 9 months. Means there is an improvement, it is a gradual improvement. So obviously numbers will be better from here on, but don't expect extraordinary numbers to come. And and this is the first time we are seeing that demand is outstripping supply. Because if you really go back to before COVID, the overall growth rates were, I think, 4 to 5% in passenger car for last 5 years. And people always used to cry that there is no demand. But this time there was demand, but people were not able to supply that. So I think as a sector, it is pretty good sector to go. And hopefully we should see revival now.
What about the HCV, MCV space?
So I think everything is recovering. See, frankly, Neelabh, if you really see 8% GDP growth will add, let's say, $260 billion to your GDP. If you add inflation, another, let's say, 4-5%, it is like $350 billion getting added to your GDP if all goes well. That is huge number, right? And that will, sorry?
I'm saying it has to come from these.
It has to come, right? Yeah. So it has to come from domestic manufacturing, domestic consumption, and the exports, what we do. So I think that $350 billion addition to the GDP is a huge number for getting things going in a big way. Hopefully, we hope that comes through, and that will lead to recovery in all the asset classes or all the sectors, if I may say, including financials, including auto, even in auto, LCV, HCV, MHCV. That is what we are witnessing. We are getting to know from the companies. I would say.
So this is obviously even reflecting in some of the numbers that we are seeing, that announcements that are coming, the quarterly announcements that are coming from these companies. We are already seeing this getting reflected in terms of demand coming back.
See, last 2 years we have seen too much of I would say ups and downs, both on supply side as well as on demand side, because suddenly COVID 2 and then things stop again, there is a resurgence, and now you are hopefully coming to a normal level of growth trajectory. You just have to ensure that the confidence is maintained in the on ground. If that is remaining, then I think rest will all take care of, because you are coming from a very low base. Also, before COVID, if you see, your GDP had come down from 7.5 to 4.5. So
yes.
So I think there is a good base formation now, and hopefully we should have 3-5 years of good GDP.
Yeah, touch wood on that. What about financial services? And we believe that financial services is the fuel to our economic engines, the engines of growth. How do you think that's going to play out?
So if you see near-term numbers, you will now see reflection of growth picking up, and also the asset quality stress coming down. So once the asset quality stress come down, companies can go all out in terms of disbursements. And we are seeing some of the great companies already disbursing for the quarter highest ever than even pre-COVID levels. So I think for let's say 11-12% nominal GDP growth, you will need at least 11-12% credit growth, at least, to keep that ball rolling, right? It's a chicken and egg situation. So if that remains, then I think many good financial companies who have a smaller market share in the total asset liability side, they can grow at 1.5x, 2x of those credit growth, industry credit growth. So I think we are fairly bullish, and just hope that there is no further lockdowns or a fourth wave, fifth wave.
Between banks and NBFCs, which one do you think, or will it be secular?
No, I think it is. We look at companies where asset quality has been managed well, be it NBFC or be it banks. See, NBFC is a last mile connectivity, and ultimately, even if you see some of the bank numbers, the largest growth engine is providing finance to NBFC. if you really see that. So I think both will do well if environment is good.
The what about insurance?
See, I think insurance, I would say it's a steady story. You should not expect fireworks. What has happened in insurance is after this COVID, the reinsurance rates have gone up dramatically, and the reinsurer is not ready to take on his books if they are not getting good premiums on the book. So I think that is where there is a sort of a, you can call it sort of a slowdown as compared to normal financial services. But I think maybe that is just an adjustment which will happen in a 1 year time. And once this COVID is totally out of way, I think that sector will also see, it's a penetration story, right? It is similar to what we talk about financials in every aspect. There is a huge penetration story which is available, and
Right.
there is I would say growth also available in that penetration. So volume growth for the industry plus penetration growth. So I think sector is good. It is just that matter of time that readjustment happens.
So do you think the demographic dividend that we talk about, and which is what I've been hearing since my days in B school some 20 years back, that India has a great demographic dividend and it will play out. Do you think that is starting to really play out, especially on some of the frontline sectors?
See, I think we feel sometimes it is playing out and then some setback comes into play. So, as you rightly said, we are 2 steps forward, 1 step backward. So, I would say the good part is the likes of Amazon, Zomatos of the world helped create job opportunities, especially during COVID times where there could have been big job losses. However, at the other end, there are so many businesses which are going automation. There are so many jobs which are getting redundant. So skills have to change. So see that it's a very tough period, I would say, because on one hand, all companies don't want to recruit high because they are using technology as the backbone to automate as much as possible. And on the other side, you have huge population coming in the workforce. So I think, and hence I think this infrastructure spend, all this is very, very important because these are all, sorry to say, but low skilled jobs. And India really requires that because we cannot afford not to give jobs to those people. So I think slow, it is always slow and steady, but things are, I would say, positive than negative.
Right. So that is sort of it about at a high level. We wanted to talk about a few sectors and get some sense from you. Uh, I just wanted to understand one more perspective, and it's a big buzzword. Digital is a big buzzword for the last few years, in fact, whether it's a digital currency or Aadhaar,
Yeah.
digital KYC, and so on and so forth. Um, and now we've spoken about the e-passport uh, coming in 2023 and so on and so forth. Um, even for MSP and farm purchases, there is a there's a portal, and farmers can participate directly on that portal itself. Uh, what do you how do you feel this is this is helping us, and are we making great development? Are we benefiting from this in a big way, or is it sort of something which is good to have and it is supporting just the creamy layer of the society?
No, I would say, Neelabh, if you see the scenario, if this COVID would have come 10 years back and India was not digitally ready, I think we would have been pushed significantly down by at least 5-10 years.
Right.
Because of this digital implementation like Aadhaar or platforms or net and all them sort, I think businesses could revive very quickly. So they could adjust to this new world of omni-channel, I would say, very, very quickly. Otherwise, you just imagine if the economy was shut down and there was nothing to deliver. You see the state of affairs, right? Even during the COVID lockdown in the first phase, I think 90% of whatever you wanted, you got it. So I think, yeah. So I think this is here to stay. This is proliferate more and more companies are becoming more savvy about it. In fact, we talking like this itself is a sea change, right? Normally, my sales guy will say you go to Bangalore and attend the function and all those things. But see, this becomes so easy, right? Like, I mean, you can convey your message without any problem. So I think this is an ongoing effort. Each and every company where we are talking are spending huge in terms of technological changes. In fact, our company is spending huge now into all these things. So I think this is here to say this is mainframe now. Earlier in the board meetings, when there was talk about technology, people would have said, "Okay, we'll wait for 2 3 years. बाद में देखते हैं. Yeah, we'll go slow." Now it is survival issue, right? Today to so many retail companies are surviving only because they could move to this omni-channel way quickly. Otherwise, it would have been difficult for them to go for the sales revenue numbers. So I think it is here to stay. You will have more and more automation, more and more blockchain kind of I would say themes and everything coming, and I mean you have to be in this space. There is no question about it.
So, we are almost at the end of our discussion today. And now, just from a tactical standpoint, we always, when we, in conversations with investors or in all the material that we put out at Kuvera, we always say that, once you have your long-term plan in place, you keep investing according to that plan. Don't be
Correct.
phased by how the markets move in the short term. These announcements, whether good or bad, and market takes, the price always takes it in its stride. And if you are investing regularly, just stick to that plan. No need to sort of do a knee-jerk reaction. What is your tactical suggestion to investors? What should they
See,
do?
my one view would be market always climbs all the wall of worries, right? Since means you take last 50 years or 30 years history, you will have had wars, you will have had all kind of issues, terrorist attack and everything. But markets have always climbed those wall of worries and have delivered returns over a period of you take any 5 year period,
Yes.
markets would have given you a positive return. So I think if you are a long term investor, then there is no case to worry, because any which ways you are investing slowly steadily every month or maybe every quarter or something like that. But let's say if you are a daily investor, then obviously these are the volatile times. You need to be very, very careful. You see what's happening in global world, especially Nasdaq. All these algo-based traders are getting whipsawed big time from here and there. So this is part and parcel of this market, right? When you have so much momentum for last 10 years, you will have, I think, at least 6 months of this volatility. So I think no need to worry significantly. Just identify few good funds wherever you want to invest, and then invest with a longer term view.
That's great to hear. And the wall of worry analogy, it's very interesting and something to keep in mind, I guess. Some of the investors who have come into the market, and this is my last question to you. Some of the investors who have come into the market in the last 1 year, 2 years, because some of the other investment opportunities, traditional investment opportunities, were not available. They've seen some fantastic returns. Even in the mutual fund space, some funds have given 50% plus returns or annualized returns. We don't think it is realistic. And how should these investors think about? Because they are quite silly. I've seen this much return in my last 2 years of investing, last year of investing. So what should we do in terms of our expectation? Do we need to temper our expectation as an investor? Should we temper our expectation?
I think so. In the rising interest rate scenario, I think there is going to be volatility. You have seen market does very well for 2 years and then it might go dormant for 1 year period. And that is part and parcel of this market, right? You discount very quickly and then you wait for numbers to come, and then as numbers come, you roll forward to another. By that time, if your flows are positive, then you go berserk on buying spree, and if flows goes negative, then obviously you will have to go through that pain. So I think, see, I think anything above, I would say, inflation plus 3 to 4% is, I think, is a good number to go by on a longer term basis. However, having tasted this blood of making 50% return shouldn't be there, because everything averages out at the end of the day. So if in fact you will be surprised, if you take last 10 years data of Nifty, it would have given you just 9 or 10% CAGR. Despite seeing so much volatility, despite seeing so much euphoria and then stagnating and all those things. So I think people should be aware of this fact. It is not a casino machine. And if you are investing judiciously, then you should look at compounding of returns rather than looking at every day and what returns you are making.
So I think with that we come to an end for our discussion today. Thank you very much, Jinesh. Some great insights. Just to summarize, we discussed COVID and how COVID has really not been of great impact thanks to the resilience of the economy, and in great part to how India has digitized over the last couple of years. We spoke about the budget and got a better understanding of how public finances and how the infrastructure spend are not very aggressive numbers compared to what the revenue projections are. So all positives on that front. We spoke about a little bit about the sectors, and lastly we spoke about how investors should stick to their investment plan, and when you are investing in markets, you should always think long term.
Correct.
And, with that, I conclude this discussion. Thank you so much, Jinesh.
Thank you, Neelabh, for having me on this session. Thank you very much.